I heard that Justin Trudeau is allowed to actually raid the Canada Pension Plan Fund to pay for a stylist to make sure his hair looks fancy all the time. Please tell me that's not true.
Ain't a cloud in the sky, ain't a worry in my mind. Looks like we're in the clear, just to live in the line.
In today's video, we're going to look at 6 talking points that you're going to hear over and over about the Canada Pension Plan. And these are done mainly by people who, either hate the government generally or hate the Canada Pension Plan. Maybe I would call them whiners and complainers. We're going to look today to see how much of what they're saying is fact and how much is fiction. Now, I'm going to give you a spoiler alert today. If you don't like facts, if you're one of those people who just likes to talk without actually knowing what you're talking about, go watch a different video, maybe catch a cat video or something, because what we're going to look at today, right or wrong, true or false, we're going to look at what the actual facts are in how our pension plan is run. So, maybe you might not want to watch this. Now, before we get into the video, a couple of things. Number one, if you are already retired, I'd like to have a sort of a quick yes or no comment. Do you feel that you're at risk of losing your Canada Pension Plan benefits between now and the day that you pass away? Do you feel, yes or no, that you will get paid your benefits? If you're not yet retired, let's say you're 20s or 30s or 40s, you're building your money up to be retired and contributing to the plan, what are the odds? Do you feel that you will not get money or that the plan will be gone by the time you retire? Again, quick comment. I'd like to see what you feel before you look at the evidence and then again after and compare and see how accurate your answer was. I'm going to speak more about our Investing Academy later in the video, but for those of you who are interested, just a reminder, it's in the first link down below. Feel free to check it out. Okay, let's get started. Let's look at talking point number 1. The Canada Pension Plan is bankrupt, or it's going broke and I'm not going to get any of my money. If this was the 1990s, I could see how this was a legitimate concern. Let's look at a little bit of history on the Canada Pension Plan. If we look back to 1996, when some major changes were underway to how to improve the plan was in serious trouble. In that year, there were $11 billion roughly of contributions that came into the plan and almost $17 billion being paid out. The asset base, so the pool of money to fund the plan, was at $38 billion. As you can see by this table, starting in 1995, a deficit started accumulating where more money was going out of the plan than was going in, and the program just got worse and worse, and it was developing some real long-term problems. Around that time, 2 major changes were made to the program. Change number 1 was that the rates of contribution were dramatically increased. The program was designed to generate a surplus of funds. And the Canada Pension Plan Investment Board was established to take those surplus funds and invest them wisely over the years to generate a bigger pool of money from which to draw the benefit payments from. That program, those changes have actually worked. The problem is we are still stuck. We collectively are stuck about 25 years ago in our impression of the fund because those talking points continue to be repeated over and over. In fact, about 64% is the most recent survey I saw of Canadians feel that they either will get zero benefits or not the benefits that they're being promised. Now, there is an actuarial report by law that is produced every 3 years to just assess the health of the program. And if we look at the most recent report, which was December 31st, 2018, so now almost 3 years ago, this report is produced by the Office of the Chief Actuary of Canada, and it looks out over the next 75 years to assess how the program's doing, are we on track, are changes needed. If we look back over the last 10 years, the fund has actually done quite well. The plan itself has generated a 10-year annualized return of almost 11%, 10.8, and over the most recent time period, the last 5 years, about 11%. The assets in the fund have grown to almost $500 billion. And remember, back in 1996, the assets that they had to draw from were $38 billion. When the plan was set up, they projected that by the year 2028, they would have accumulated $500 billion in funding. Well, they're 7 years ahead of that program, so that's a positive sign. You'll also see, given the what I would call reasonable, very prudent assumptions going forward, that the surplus, which is now projected through till 2040, is expected to grow to be more than $1.5 trillion. I know the fund is often bashed as to their investment decisions, but it's actually performed quite well. And if we look back even recently through the COVID crisis, we'll see that the fund did drop early in the year, but then they've recovered much like the market has and are growing at a reasonable pace. One of the biggest changes for this improved performance is a mandate change. And if we look at this next chart, we look back at 1999, the Canada Pension Plan had one mandate. All of the money, 100%, was invested in government bonds, Canadian government bonds. As recently as 2006, you'll see that the one investment strategy has changed to 6 investment strategy. And instead of having just all government bonds, the fund now includes real assets. There is still a healthy component of fixed income, but equities now at the point, back in 2006, made up 63% of the fund. You'll also see geographical diversification beyond Canada. Canada at the time had 64% of the assets invested at home here and 36% globally. Now, let's look at where we're at today. As of 2021, there are 23 different investment mandates. The fund has grown, like I say, to approximately $500 billion in assets, 23% still in fixed income. The equity component is 55%, almost 56% of the pie chart. And real assets, things like infrastructure and types of investments that the average investor just doesn't have access to, now comprises 21% of the fund in general. Geographically, the fund invests 84% of the money outside of Canada, with about the remaining 16% here at home. When we look at all the data, we take everything into account, and we look at this talking point of the CPP is going bankrupt, there's not going to be money there when it's my turn to collect, I would say that is fiction. I don't believe that the CPP is in any danger, as it stands today, of running out of money. Your benefits are secure. Talking point number 2 is that the government is going to raid those funds, raise their pensions, give themselves big raises, and just screw the taxpayer. As I mentioned, there is $500 billion sitting in that fund today. Certainly, it's an attractive target. The government has a problem, though. They actually have a couple of problems. It's called the law. The first hurdle for them is the Canada Pension Plan legislation itself, which is a 249-page document. I'm obviously not going to get into every detail of it, but the keys are that the funds are segregated from the general revenues. They're not allowed to touch those for any purposes other than the CPP. If we look at the actual act itself, in Section 108, there's actually an establishment of a separate account called the Canada Pension Plan account. All the money that comes in from CPP contributions is credited to that account. The legislation specifically says that the money must be transferred into that Canada Pension Plan account, including all amounts received under this act as or on account of contributions under subsections 8.1, 9.1, and 10.1, or otherwise on account of the base Canadian pension plan. Following that, there's the Canada Pension Plan Investment Board Act, and it specifically says that once the money is put into that account, the objects of the board are, and I'll highlight one in particular here, Section B, to manage any amounts transferred to it under Sections 108.1 or 108.3 of the Canada Pension Plan and its right, title, or interest in any designated securities in the best interests of the contributors and beneficiaries act under the act. So the evidence is in, it's pretty clear. Can the government just willy-nilly go and pull the money out of the Canada Pension Plan to pay for other things, including Justin's haircuts? The answer is no. That talking point is just fiction. Talking point number 3, the benefits of the Canada Pension Plan pay are so small anyway, it doesn't really matter. It won't even pay for my retirement. You hear often people will say, gee, look at those benefits. The average benefit is somewhere around the $700 range. How am I supposed to retire on that amount of money? The fact is, you're not supposed to retire on that amount of money. The Canada Pension Plan was never anticipated that it would provide for a full and robust retirement to Canadians. In fact, it was established to replace 25% of your average wage that you've earned over your working career. Now, there are changes that have taken place. That's being increased to 33% now, which is an improvement. But it was never designed for a lavish retirement. There has always been the expectation that as a working Canadian, you're also going to help take care of yourself, when your retirement years come. So you're expected to invest. You're expected to save some of your money, and the CPP will recover the necessities of life, which is what it was designed to do. But if you want extra things in retirement, that's something that you're going to have to put money aside for yourself. Another thing to consider also is the Canada Pension Plan isn't just paying benefits to existing retirees. There's also a disability feature to it. There's also a survivor benefit to it. So if one spouse passes away, a portion of the pension will move on or to the survivor. And there's also a very small death benefit that's payable, but it does form part of the overall program. So it's not quite as simple as if I just took that money myself and invested it, I'd be able to have more in retirement. So talking point, the CPP won't pay for my retirement. I think that is in fact a fact. I think it's misunderstood, because that's never what the Canada Pension Plan was designed to do. But yeah, if you're retiring only on your Canada Pension benefits, you're going to have a pretty tough retirement. Talking point number 4 is the Canada Pension Plan is one big Ponzi scheme. Before we get too deep into this, let's remind ourselves what the definition of a Ponzi scheme is. If we look first at the Merriam-Webster dictionary, they define a Ponzi scheme as an investment swindle in which some early investors are paid off with money put up by later ones in order to encourage more and bigger risks. Cambridge Dictionary says it's a way of deceiving investors. In other words, people who give money to a company hoping to get more back by using the money they give to pay interest to existing customers rather than investing it. Now, in a scheme like this, there are 2 key components. Number 1 is you're promising to pay existing investors with new investors' money. And there's a really critical element here. You don't invest that money other than spending it on yourself. So it's new money coming in that is solely funding the existing shareholders, existing investors. Now, before the reforms that we spoke about earlier, I could say there were elements similar to a Ponzi scheme, but there's also some big differences in that it's not illegal to run the Canada Pension Plan. It is illegal to run a Ponzi scheme. When you factor everything in, despite the fact that there are some similarities between the way the program is structured and a Ponzi scheme, is the Canada Pension Plan just a big Ponzi scheme? That is fiction. Talking point number 5 that you're going to hear a lot is the younger generation is getting screwed because they're paying to fund the elders. Now, this is a very interesting one. Let's have a look at a couple of demographic charts and maybe try and explain how this works and why this is happening. If we look at the first chart, this is a Canadian age pyramid chart that goes back to 1996 when these changes came about. You will clearly notice that the bulk of the Canadian population fell between the ages of 30 and 50 at that time. What do these people do? Typically, they're working. These are contributors, so they're putting money into the plan, and they're paying for the pensions of the people who are already retired. If we now fast forward 25 years to today, there's a dramatic shift in this pyramid. All of those 30 to 50-year-olds 25 years ago are now, of course, 55 to 75. What do 55 to 75-year-olds do? Well, typically they're going to be retired. In that 55 to 75-year-old band, that is where the bulk of Canadians are now. The pension plans for them are being funded by the previous 30 to 50-year-olds, and you can see how much narrower that band has come as a percentage of the population. What has caused this major shift? Well, there's 3 key things that I've identified. First of all is life expectancy. People are just living older now, and you can see by this chart that back in the mid-60s, the average life expectancy for a man was 69, a female around 75. Now that has grown to around almost 80 for men and about 85 for women. And that's just projected to go up as medicine, increases our lifespan. And by the year 2076, and keep in mind that this plan thinks that far ahead, men will be living to an average of about 86 and women to almost 90 by the time we get to that point. Another major factor is just smaller families. The fertility rate in Canada has dropped quite significantly. If we look back to the 1940s, 50s, 60s, the fertility rate was always sort of in the 3 to 3.5% range. So there were new workers being born all the time. That has declined over the years to a point where it's only at about 1.5 now. So there are fewer workers being born today who will in 18 to 20 years start working, who will be funding this big group of people who are retired. That's another big contributing factor to why the younger are paying more today. Third key part of this is that immigration, although it's been there, it just hasn't filled the gap with the declining fertility rate. The immigration rate has gone up, but it is projected, starting right about now, to go back down to around the 0.6% level, and there's nothing really obvious that's going to change that. So, talking point number 5, the younger workers are getting screwed, paying for the older people. I would say for the 3 reasons that we've just talked about, and when you just look at the raw way the system is put together, that is a fact. Talking point number 6, and this is a short one, the CPP is a disaster. And I find it interesting when you look online, there's a lot of people who just say this is the worst plan in the world and we're getting screwed. And I never see any evidence to back that up. But we're going to look at some evidence today to see how accurate that statement actually is. The first thing we're going to look at is a report by Mercer Canada, and it's the Mercer Global Pension Index. And this is a study, this is a recent study from 2020 that looks at 3 major elements of a pension plan: adequacy, sustainability, and integrity. So it looks at the adequacy being, does it provide for some standard of living, or what standard of living that is for a retiree? Sustainability, is the plan well funded? Will it be there? Can we rely on the money? And the third being integrity, and this is what is the oversight? Is the plan, can you trust the information that you're hearing from the plan itself? How does Canada rank in this? Well, with the most recent study, although we're not at the very top of this, Canada ranked number 9 in the globe. Netherlands, Denmark are ranked to have the best pension systems in the world, but Canada is near the top in 9. And even if you look below Canada, some economies, some countries you'd expect to do quite well: New Zealand, Germany, Switzerland. You think of the UK and even the United States in there, France. You'll see some companies that you would expect would have perhaps stronger plans in Canada based on the rhetoric that you hear. But in fact, from a global perspective, we're not doing bad in that regard. Another recent study, 2021, by the Global SWF annual report, says that when you look at the external recognition of top pension plan funds, Canada, the CPP itself, is one of the, if not the, most advanced pension plan. And this is just a function of amongst its global peers, how well is the Canada Pension Plan run? And it is considered to be a bellwether for other pension plans to follow. So on this talking point, is the Canada Pension Plan a disaster? Unequivocally false. Now, moving on to what's not really a talking point, but it is a point of confusion. In a recent video I posted, it looked at the current contribution rates and looked at how much people are actually contributing to the plan and eventually how much you would get out of the plan. And there is obviously some misconception in that area. We received a comment from a viewer in summary. It says, so if you take $6,332 times 39 years, which is the full contributory period, that's $247. And you take that, you assume it's invested, it'd be close to $940,000. And then he goes on to extrapolate. That's a big chunk of money. And if you lived X number of years, it doesn't make sense. The math doesn't make sense. Where does all the rest of that money go? I thought I would just take a quick moment to clarify that. What he's referring to there, the 6,332, is current contribution rates. So yes, if you earn that maximum contributory amount in 2021, that's the amount you'll contribute. Well, technically you won't contribute that. Your employer will contribute half and you'll contribute half. So first of all, you're actually only contributing half of that, or $3,166.45. The key to this calculation, though, is that amount has increased every year, and it will increase every year. You haven't been contributing $6,332 for the last 39 or 40 years. So let's have a look at those numbers. If you look back over the past 10 years, the amounts, as you can see, were lower. And that's because they are adjusted every year. And so if we look to 10 years ago, in 2011, the maximum amount that a individual would have contributed is $22,1760, with yours and your employer's added to that, or if you're self-employed, $44,3520. So compare that to the 6,332 that went into this calculation today. You can see how that number has increased. Now, if you go back to 39 years ago, the number is dramatically different. If you go back to 1982, an employee would have contributed $268.20 to the plan for that entire year. Certainly not the $6,300. Even counting your employer's contributions to that, the contribution would have been $536.40. I applaud our viewer, our subscriber, who went to the trouble to do those calculations, and it's a legitimate question, to second guess. I would just say, though, clearly the math, the input wasn't correct on that. So, if he wants to rerun it, factoring in the very, very low contributions 39 years ago, running right up to today, that would give him a more accurate view of whether it's fair, the money you put in to the money that you're taking out. At the beginning of the video, I asked the question, if you are retired now, do you feel that the government at some point will cut back or you'll lose your benefits? Having listened to the actual facts of the program, is that answer the same? Has it changed? Curious. If you are a younger worker who is contributing to the plan, a question I would ask you is, having looked specifically, I would say particularly at the funding and the longevity that the plan is expected to produce, do you feel more or less secure? Do you feel that when it comes your turn to retire, are you going to be getting benefits from the Canada Pension Plan? Yes or no? I think that when you are preparing your projections, when you're planning for retirement, I don't really care how old you are right now. I believe it's legitimate, it's safe, it's conservative, in fact, to factor in a reasonable amount, take the money that the government's projecting that you will get right now, and put that into your numbers, because I don't think that's just going anywhere at all. Near the beginning of this video, I mentioned our Investing Academy, and I have some very exciting news to share. Whether you're a private group member, whether you're a current student of one of our training platforms, we are introducing live sessions starting soon, starting on July 10th for the first one, where you will be able to interact directly with the presenters, and we're going to be bringing on a series of presenters to just add some more value to the experience that you're getting, and to be enhanced part of the way our community works. And we're very excited to unveil that. If that's something that interests you, you want to learn more about it, just click on the first link below. That'll take you to the website, and you can read and get all the information that you need there. That's a wrap for today's video. I hope that these talking points that we've discussed on the Canada Pension Plan specifically have been cleared up, whether they're fact or whether they're fiction, whether they're sort of somewhere in the middle. I hope you found value. If you did find some value in the video, I appreciate a thumbs up for that. Don't forget to subscribe. We have 2, 3, 4 videos a week that we put out on topics similar to this, and we'd like you to be able to catch as many of those as possible. So I will say bye for now, and I thank you for watching. We'll see you in the next video.